Coming up today, stocks lower on the back of surge in oil and bond yields, why the Fed may not cut next month, Q3 earnings season kicks off, inflation data coming Thursday, could the stock market crash this month, the latest on China, a large hurricane approaches Florida, what's next for the Middle East, and Russia becomes the first central bank to buy silver. It's another big week, guys. Let's go. And welcome back. Hope you're doing well to start off another big week on Wall Street. We got quite a lot on the calendar in the next few days. Kicking things off, 3-day Nvidia AI Summit from Washington, D.C. Amazon's Prime Day sale kicks off on Tuesday. Elon Musk gonna unveil Robotaxi on Thursday. Then since we're a few weeks into the new quarter, we get to hear earnings results from the prior quarter. Q3 earnings kicking off this week. Pepsi set to report earnings. Closing bell tomorrow. Delta Airlines on Thursday. Then as usual, the big banks on Friday. JP Morgan, Wells Fargo, Blackrock, amongst a few others. Also on Thursday, we get Consumer Price Index, CPI inflation data. And probably more importantly for global financial markets this week, we're on the cusp of a response from Israel towards Iran, in which it's still unknown whether they intend to attack their oil assets. And stick with me today because I'm going to dive into that, give you the latest on everything that's happening over there, along with my opinion on what I think is going to happen, along with a few other interesting things. So make sure you stick around for that, and I'll get you updated on everything else that's happening across markets. What's moving, what are the trends, and what else am I seeing out there today? But let's kick things off with some other big moves happening out there today, and a bit of an extension from last week. Treasury bond yields climbing back up. Now got the 10-year at the important psychological level of 4%. And this is on the back of a hot jobs report we got last Friday. Kind of surprised the markets a little bit, implying that the economy isn't about to fall off a cliff, or so they say. Jay Powell came out a couple of weeks ago with a big 50 basis point cut with a loose justification that he's worried about the labour market, potential softness. However, in my opinion, he would have known the unemployment rate was actually set to drop a week and a half later, which it did to 4.1%. We now got the likes of Goldman Sachs lowering their recession odds on the back of this strong jobs report. In fact, only giving the chance of a US recession at 15% now. In other words, they're highly expecting the so-called soft landing to continue. On top of that, they also bumped up the S&P 500 target for the third time this year, getting much more bullish on the market. They now expect the S&P to reach 6,000 in 3 months' time and 6,300 in 12 months' time. They expect earnings next year to grow 11%, double-digit earnings growth. However, there's a bit of a building narrative across the financial community. The Fed didn't need to cut 50 basis points, like I originally said. Now it's pretty much become accepted by the markets that we're not going to get another 50 basis point cut, as they'd actually been pricing in only a week and a half ago, with some even going as far to say the Fed is out of sync, and that could be actually great news for stocks. If they didn't need to loosen monetary conditions that much because everything's still holding up, then that kind of just pulls fuel on the fire of this bull market. And now there's a building narrative that the Fed may not even cut next month, as their meeting's on the 7th, 2 days after the federal election, and interest rate traders are starting to price in the same thing. In fact, even giving 15% chance they'll stay on hold. 0% chance we'll get a 50 basis point cut, still giving the vast majority of probability that they will trim 25 basis points. But look at that move in the 2-year we've had over the last week. It too just sitting below 4%, and the 10-year looking to be on solid footing as well. Definitely a bit of a repricing in the bond market. Swiftly moved lower. However, we've already bumped up over 40 basis points just in the last couple of weeks, and that's caused TLT to pull back. However, we are in technically oversold levels here. DSI is in oversold territory, and the price getting down to my bottom buy sell band, meaning we could be nearing a short-term technical bottom. And just looking at some reactions from popular financial posters over on X, with one coming out today saying bond yields are not rising because of the jobs number. They were rising before that. They're rising because post-Fed rate cut, the bond market doesn't think rates are restrictive enough to control inflation, and government spending is out of control. Another one, gold has been telling Powell that he messed up. Now yields are telling him that he really messed up. Will he listen? And like I always say, the mainstream media can say whatever their masters want them to. However, the markets don't lie. Money doesn't lie. Looking at a spread chart of inflation-protected treasuries versus regular treasuries, and what I always refer to as the market's expectations of inflation that had been coming down a lot going into early September, thanks to a swift pullback in the price of crude oil. However, now with a bump up in crude and an ultra-loose Fed, don't ever forget how loose and supportive policymakers are at this particular point of time, because in a few months from now, most people will forget it, and in a year or two, it'll be told in another way from mainstream media. However, at this point of time, they are super supportive of markets, and that's just setting up for the potential resurgence in inflation, and that's why the market is swiftly pricing in that as well. Not to mention the commodity index as a whole, also pushing up. And so like I've been saying, Fed seems to have turned a blind eye now to inflation risks. But who knows, that may all change come early next year. So what the market will really be looking for this week, on top of inflation data, is earnings results from the banks along with their forward guidance. No doubt Jamie Dimon will come out with some cautious language, sees risks on the horizon. End of the day, market only really cares about how much do they expect to make next quarter and how was their most recent quarter. Analysts expect Q3 earnings to come in year-over-year growth 4.6% for the S&P 500, and if so, that would mark the fifth consecutive quarter of year-over-year growth. And so we'll be keeping an eye on what the trends are in beats and upside surprises along with guidance. And there's a look at JP Morgan ahead of this Friday's earnings and the financial sector as a whole, which has been one of the leading sectors of the last few months. In fact, looking at my sector breadth table indicator, it has the third highest average score after energy and just slightly behind industrials. But in terms of long-term breadth, it's only second to utilities. 91% of financial stocks still above their 200-day moving average. And just a quick reminder, if you want to get access to all of my 28 custom indicators for TradingView, well then for this week only, I'm offering 50% off a yearly plan. Just click the link below this video, head on over to my website, clickcapital.io, and you can get all my indicators and chart layouts that you see me use in these videos every day. And I'm sure they'll help you better understand the market and spot opportunities like they have done for me. So if you're interested in taking advantage of that, just use coupon code TIGR and get 50% off a yearly plan. And there's a look at the Q3 earnings calendar as we really kick things off this Thursday and Friday. A few more of the blue chip stocks next week. Then we really get into the thick of it as we approach the end of the month. Mega cap tech coming on Tuesday the 22nd, and then we actually peak in the first week of November. However, before those bank earnings, we'll be looking for CPI inflation data on Thursday. Market is starting to get worried about that. There is a building narrative, just like I showed you in the spread of inflation-protected treasuries are starting to climb. Now got massive stimulus from China, what looks like a full-blown war in the Middle East. Economy and jobs market apparently holding up. Government spending off the charts. This is all inflationary stuff. However, I don't expect that to show up in CPI this week. A lot of what's happening now can take a few months or even more to show up in the numbers, and I'm pretty sure they're not going to feed us a really hot inflation number right in front of the election. That would be surprising. Core inflation month over month expected to come in 0.2%, year over year 3.2%. And I'd be expecting a 3.2 or a 3.1 to keep markets on a sugar high. And like I said, maybe next year we get all the real data. As all these government agencies seem to have a lot of discretion, with the headline prints we get fed in the heat of the moment. And just keep in mind, as it stands now, S&P is actually tracking on its best year-to-date performance in an election year, certainly broken away from the pack of average election year performances. And looking back in history, when we do have a hot year-to-date performance coming into Q4, along with an election year, more times than not, October finishes lower. If not, we get a little bit of a fear spike. Just also keep in mind, we're at a bit of a crossroads on what sort of path the stock market takes here. Down the bottom here, weeks after the first Fed rate cut. Now, typically, if the Fed goes slower, that's good for the stock market. However, if the Fed goes big and hard and quickly cuts interest rates, stock market could start tracking on a recession path. So like I said, unless we get a really big pullback or VIX spike in the next couple of months, maybe the stock market's going to keep tracking on a no recession path. However, we can't rule out any sort of black swan before then. And like I said, especially this month, looking back in market history, October 1929, October 1987, October 2008, all some of the worst crashes and fear spikes in market history. There's something about October where we see these types of events. And so who knows, this thing in the Middle East could really blow over, or something else we're not even talking about or can't even see right now. And that's what makes investing so challenging, and why no indicator or anybody out there can get it right 100% of the time, is because nobody can see the future with 100% accuracy. We've also got JP Morgan's strategy chief saying he's getting increasingly queasy and that investors should dial back risk amid market distortions. He said even though stock market's pricing in a soft landing, there are potential shocks that pose a higher risk to investors, pointing to high valuations creating a lot of risk, and that he's particularly cautious on keeping money tied up in high-flying growth stocks. And he recommends investors balance out their portfolios more towards value shares and international equities. And we also may have just got another bad omen for the stock market. Jim Cramer says strong jobs report suggests no imminent recession, and that's good for stocks. With one commentator saying, translation, we're already in a depression. And so it's true, stocks are pretty stretched here. Just looking at the S&P 500 on a monthly chart, got my reversal signals, just putting the fifth consecutive reversal signal. Now that doesn't mean it's always a definite top. Like I said, no indicator's right 100% of the time. However, it can indicate things may be getting near exhausted or ready for some consolidation or a pullback. Just looking at the last two bull markets that ended on the monthly chart here. Back in mid-07, my reversal signals fired off, almost nailed the top to the tick, and then prior to that, in the late 90s as well. they were firing off. So no doubt, prices could keep melting higher, keep walking the line. Stock markets are prone to do this. To stay on these parabolic grinds for a lot longer and further than most of us expect. However, this is just the US stock market. As investors, we don't have to have all of our wealth completely leveraged to any one country, even if you reside in the States. That's what's known as home bias. Because even on American stock exchanges, you can get exposures to all around the world. Like one I'd been talking about all year, China. ETF FXI had a massive divergence with not only American stock markets, but international stock markets over the last 3 years. However, we've done a massive momentum thrust up these last 2 months off a low. With the Chinese stock market already up 75% off those lows. When markets bounce off bottoms, they bounce swift and hard. Just showing back here was a moment in time, a fleeting opportunity. And in fact, as we get more data pouring in, just showing what a monster rotation it's been. In my 20 plus years of trading and investing, this is one of the biggest, most forceful rotations that I've ever seen in major markets. Not just talking about like a penny stock or something. I'm talking about entire country moving like crazy, the volumes. As we witness a generational rally right in front of our eyes. The Hang Seng Index, best 3-week rally in 50 years, going back to the 70s. And it's not really comparable because the market was way more tiny back then. And just like tiny markets, they often have a lot more volatility. So on modern day markets, from the late 80s, so to speak, when financialization really swept around the world, this has been the biggest momentum thrust in Chinese shares. However, there's still plenty of skepticism and pessimism out there, and no doubt we're going to see a lot of volatility. In the short term, we're certainly stretched. I'm expecting a pullback, if not this week, just around the corner. No doubt we're going to retrace some of this big move off the low we've had. It's just what markets do. Could prove to be another opportunity to buy the pullback. However, a lot of the skepticism is saying that the stimulus is not enough. They need to do more. But that's what I've been saying over the last couple of weeks. I don't think they're done. They're just getting started. And we're likely to see more stimulus in the form of fiscal policy, which means government spending. Monetary policy refers to what central banks are doing. And we've also got Goldman, like a few others on Wall Street, starting to change their mind on China, raising their forecast for Chinese stocks, getting bullish on their market and the government's stimulus package. Said investors are still very light in allocations, valuations are still good. And it's funny how the narrative of Wall Street, from China being uninvestable to China being undervalued, just took a 70% rally off the bottom to do that. But here's Goldman's top 10 reasons now to buy China equity. You're welcome to pause your video player if you want to take a deeper look, but it basically all relates to the stimulus. And according to Zero Hedge, Goldman went on to say, to escape deflation and for the rally to be sustainable, China's M1 has to overtake its M2. For that to happen, China will need to unleash a historic credit impulse, record new debt creation, launch quantitative easing, and global inflationary shockwave. And so basically M1 money supply, that's the most liquid form of currency, like currency actually in circulation in the economy, physical coins and cash, whereas M2 includes M1 plus also other less liquid forms, but still immediately available, like savings accounts, money market funds, all that type of stuff. And so you can see in the blue line here, China's M1 money supply year over year versus their M2 in the red. Big divergence, and why Goldman's pointing towards they need basically massive new currency creation. They need to do what the Americans have been doing for the last 15 years, flooding their markets with liquidity, both from the government and the Federal Reserve. Because believe it or not, China has a deflation problem. Prices decreasing, and that's never a good thing for economy. That's why ideally we want 1-2% of inflation, because in a deflationary environment like we've seen in Japan the last 30 years, that makes people not want to spend their money. Because with deflation, money's better kept in your account because it'll be worth more in a year's time from now. Whereas inflation has the opposite effect, especially too much of it. It erodes a currency's purchasing power. And so China has been flirting with deflation the last year or so. And so they have all the reasons to flood their market, to get underneath that. But that's a dangerous setup for the world. The rest of us, especially here in the West, are still grappling with structurally embedded inflation. And then China, the world's second largest economy and largest consumer of commodities, starts flooding their market to try and stimulate inflation. Well, that has the real risk to spill over to the world along with global markets. And like I said, this comes at a time when we've got the US stock market and property market at all-time highs, government spending off the charts, and now the Fed's decided to go ultra loose as well. The risks are to the upside. And so Chinese officials are holding a press conference later on today in the Asian session, which we may hear some more measures coming out from them. Their stock markets are poised to reopen on the mainland after they had National Holiday Week last week, celebrating the 75th anniversary of the People's Republic of China. And we've been hearing stories that there's been a frenzy from Chinese looking to open new brokerage accounts. They even set up stalls over the weekend throughout their national holiday. So a lot of the Chinese have been watching everything that's been happening over the last 2 weeks, been trying to open an account, they still may have a lot of buying to do this week. And once again, FXI just marches higher today. Again, on just monster volume, 218 million units traded in this ETF. However, like I said last week, expect a lot of volatility. Like I said, Tiger Brokers is not going to keep printing these massive green candles forever. This type of move is often a good sign for the medium long term. Big rotation coming in. However, it's so stretched here in the short term. We're literally 54% above the 50-day VWAP. Whole candle above my buy sell band. You've got to expect huge volatility. And just like Charlie Munger once said, if you can't handle your stock, or even your portfolio for that matter, going down 50%, then you shouldn't be in the stock market to begin with. Because just think about it. If you're trying to make 1,000% or more in your portfolio over the next 10, 20, 30 years, 30, 40, 50% is no big deal in the long run. It's just in the heat of the moment, especially if you're obsessively watching your portfolio, logging into your account a dozen times a day, watching it go down and down and down, week after week, month after month, why most people throw in the towel after a 30, 40% drawdown. And it's why it's important to have a long-term vision and know what you hold. Because just because a stock goes down 20, 30% doesn't mean the business has changed 20 or 30%. It's just market's perceptions, sentiment, and liquidity in the short term. And that's why you should always keep an eye on the company fundamentals. If the company's still tracking in the right direction, revenue's still increasing, there's still a technical uptrend, and you just got to stomach the volatility. And I'm not just talking about Tiger Brokers, I'm just talking about in general. People get so nervous if a stock pulls back 20, 30%, whereas in my mind, that's really no big deal, and you should expect that. Same with your portfolio. These are not your grandma's bonds, and so they're going to move around a little bit. And if you've got the stomach to hold them, well, then you stand to benefit from the potential long-term return. Moving on today, we've got a Category 5 hurricane set to make landfall in Florida sometime around Wednesday. There's the eye of the hurricane there, gathering pace in the Gulf of Mexico, threatening a dangerous storm surge in Tampa Bay, leading to evacuation orders and long gas lines, and leading more urgency to the cleanup of Hurricane Helene, which swamped the same stretch of coastline less than 2 weeks ago. We've got Tampa Mayor saying, "This is the real deal here with Milton. If you want to take on Mother Nature, she wins 100% of the time." And just looking on the knock-on effects of financial markets, it's already starting to be priced in. Shares of a generator maker soaring, and insurance stocks taking it on the chin today as well. There's the generator maker, Generac, holding $10 billion market cap, ripping up today over 8.5% on volume, on expectations of a surge in demand for generators. And look at the insurance ETF, KIE, down about 3.5% today, also a massive volume, as they're set to be hit with potentially a lot of claims coming out of it. However, in addition to inflation data, bank earnings, Tesla robo-taxi on Thursday, one of the other biggest events, dominating headlines right now in markets is the continually escalating situation in the Middle East, which crude oil's already been responding to last week. And this comes on the 1-year anniversary of October 7, 2023, when Hamas, at the direction of Iran, launched a massive surprise attack on Israel, committing unspeakable crimes and kicking off this war that Israel is determined to win. They've been picking off Iranian military subsidiaries and proxy groups in the region, and all their leaders one by one. Hamas, Hezbollah, they've taken out dozens of leaders, and we're just hearing reports today from Unusual Whales that just after they killed the last Hezbollah leader last week, apparently on the same day the third one's been sworn in, they've already taken him out. We're potentially on the cusp of a major response from Israel directly inside Iran. And there's their supreme leader there, standing with an AK-47. As we're seeing the biggest escalation in war many of us have seen in our lifetime, after Iran sent almost 200 ballistic missiles in the largest missile attack we've ever seen in the world towards Israel. The second time this year. Now Israel, as they promised, will attack them directly back inside their own country, for which Israel's copped a lot of criticism. However, they've pushed back and said, how would America feel if Iran sent 200 ballistic missiles directly into their country? Would America respond back to that? And so now we're all speculating on what Israel may do back. It's been said they could take out their oil infrastructure, which I'm thinking they may not do, because even though that's a long-term strategic move for them, to attack Iranian finances, that will send the price of oil soaring, and that'll upset all Israelis' alliances. I would think it would be a more calculated move for them to take out their nuclear facilities. The biggest risk to Israel, as Iran openly calls for the elimination of Israel. They want to kick them out of the region. And apparently we're just getting reports there's been an earthquake in Iran that fits the profile of a nuclear test explosion. And so both sides don't look to be stepping down. If Israel wants to do this properly, they'll have to go big right from the start and cut off the Iranians' ability to even launch a nuke. However, even if we don't see a direct attack on Iranian oil assets and refineries, that could still keep crude bid just based on fear. However, if they did attack their oil assets, crude could spike up to, who knows, $90 a barrel, $100 a barrel overnight. However, if they just did a large-scale attack on their nuclear facilities, maybe other military assets, leadership, it's likely to still cause some volatility in crude. However, this is such a dynamic, fluid situation. Pretty much anything can happen at this point in time. Just keep in mind, a lot of what we're talking about is speculation, and of course, everything I say is my opinion. And at the end of the day, Iran's not even in the top 10 leading crude oil exporters in the world. It's actually the Saudis and the Russians that export the most of it around the world, then North America, and then other Middle East countries, Norway, Nigeria, and Kazakhstan. In fact, the Iranians sell 91% of their oil to China, so I don't think China would be too happy if the Iranians' oil supply was attacked as well. And according to the Open Source Intelligence Monitor, they've reported that the Israeli public broadcasting channel, they said the United States has offered Israel an extensive package which includes international political backing, additional military assistance if they decide against attacking targets inside of Iran, likely to include nuclear sites. So once again, the current administration may be looking to send more money overseas to try and buy their way out of this politically dicey situation at this point of time. Something they've already done with the Iranians, sending them billions of dollars, saying pretty please, don't build any nukes. Still went ahead and did it anyway, just like this meme shows. Somehow it's American tax dollars that could be financing all of this. And so it's really unclear what the current American government and their position is on this whole thing. Because at the same time of apparently supporting the Israelis, they also just sent a large check to Lebanon, $157 million in aid, after the Israelis have been striking there, taking out their enemy, for which they've been heavily criticized as they haven't quite sent the same amount to their own citizens who have been suffering through emergencies as well, in which the current sitting VP posted, with that $157 million, that brings the additional support of US assistance to Lebanon over the last year to $385 million, spoken as a badge of honor. However, it's turned out to be one of the most ratioed posts of all time, and that's the difference between likes on the comments of the post to the likes of the original posts. And like popular user on X, Greg said, I hope you're talking about Lebanon, North Carolina. And that could be part of the reason why we've seen a bit of a change in the odds over the last few days. Big spike up for the Republican nominee, currently priced by Polymarket, almost 54% chance of winning versus 45% chance. And like I said, we've seen a bit of a divergence there over the last week. And so in my opinion, with this current US government kind of addicted to sending their own taxpayers' wealth overseas, and a lot of people just hear that number and don't really connect to it. However, that will have to be paid back somehow, some way, with labor by regular Americans. And whether that's just around the corner or they kick the can down the road, the fact is Americans will have to go to work and translate their labor into tax dollars to send to all these countries overseas. Current administration spent more money defending the border of Ukraine than their own southern border, of which approximately, it's been said, 12 million illegals have crossed over in the last 3.5 years. At the same time, a push to not require voter ID, which again, in my opinion, is just a little curious. However, at the end of the day, how it affects us investors, huge government spending creates huge debt, and that correlates with gold, even when you adjust for inflation. The more a country blows out its debt, long term, it just devalues that currency, just like we've seen with the Japanese yen. And this is why we're also getting a momentum thrust in the commodity complex. Rolling 4-week change in the equal weight commodity sector, 9%, getting a bit of rotation commodities. And so central banks around the world know this. For a long time, a lot of their reserves have been in US treasuries. However, what you'll find in history, when a country blows out its debt, it inevitably tries to inflate away that, and that demolishes the value of its currency. Because you don't want to hold bonds in inflation. Like I said, they're better for deflation, because with bonds, whether that's a 1-year, 3-year, 5-year, 10-year, you get your principal back plus some interest. And so if there's deflation, then your principal's worth more. If there's inflation, it's worth a lot less. And so that's why we've seen a big push by global central banks accumulating gold like crazy, trying as hard as they can to get off the US dollar, not only as a reserve, but to transact in. And now we're getting news that Russia is shifting its precious metals strategy, becoming one of the first major central banks to add silver alongside gold, platinum, palladium, potentially impacting global markets as central banks reconsider silver's value. And this was on the back of silver breaking out to a 10-year high on Friday. And if Russia are going to do this, who's to say the others won't either? China, along with all the other BRICS nations, they may be looking to diversify their reserve into not only gold, but many other precious metals, anything but the US dollar. And there's a look at silver today. Along with gold still hovering near all-time highs, and even though the trade's been a little crowded, it still has potential to spike with what's going on in the Middle East, just the same as crude as well. Expect to see a lot of volatility over the coming days and weeks. Just like the crude oil volatility market is telling us. You could think of this as the VIX for oil, currently tracking at 48, implying an annualized movement of 48%. Not only that, we've got stock market volatility ticking up as well. The VIX, 22.6, and option dealers really pushing up. The premiums they're demanding over realized, now sitting almost at 12. That means the implied volatility on S&P 500 options is averaging 12 points above realized, because the stock market is still not moving around a whole lot at this point in time. And we'll wrap up the news and data today with an interesting slide, apparently from BlackRock and Brazil to investors, which kind of stuck out as odd to me, and why they're doing it in Brazil as well. Pretty much really coming out with a huge bear case for the US dollar, showing its purchasing power has declined significantly over time, whilst making a very bullish case for Bitcoin. And so it's interesting to hear BlackRock and their iShares franchise, not only the largest ETF provider in the world, but also the largest asset manager, going against the US government. Maybe BlackRock's looking to kind of separate themselves from that, separate themselves from the US dollar, de-risk from it themselves, become more of a global company, and Bitcoin is part of their hedge, because they don't like seeing what's going on with the US government balance sheet as well. And there's a look at Bitcoin, bouncing beautifully off the 50-day VWAP last week. Like I said, liquidity's gone vertical. US government's still spending like crazy. Can't help but sending billions of dollars overseas. That's all bullish for Bitcoin, priced in the US dollar. However, it too should see a lot of volatility over the coming weeks as we go into the election. A Republican win could see it spike to new all-time highs above $73,000 a coin. A Democratic win may actually see it pull back. And there's a look at the dollar, just pausing a little bit today above 102, as it's bounced over the last week in tandem with bond yields. Also interesting, we've got the 10-year, 2-year bond yield curve close to going back to inverted territory. So that uninversion may not be the clear-cut signal that a lot of us were thinking. Maybe we still get the recession, but it's just been pushed down the road a bit further. And there's a look at Nvidia. Like I said last week, we had a bunch of bullish seasonality coming into the stock, currently going through AI week. It too, just a stone's throw from all-time highs, above 141 a share. And there's Tesla, pulling back today as we go into Robotaxi Thursday. If the market really likes what they hear, this could rip back up to highs in no time. And so once again, the dip may get bought on this. Other than that, it was a pretty soft day for mega cap tech. Apple pulling back over 2% and Amazon 3% as well, along with Microsoft still trading heavy. And tech in general has pretty much been consolidating for a few months now. But like I said, guys, energy stocks, clear cut, holding up the best in the short term right here and now. And look at that, REITs pretty much gone as low as possible in the short term. However, in the medium term, it's still energy. 90% of stocks above their 50-day moving average. And that's why my most recent stock pick was also in this sector, which also serves as insurance for the rest of my portfolio. Because typically when oil spikes, the rest of the market pulls back, while energy stocks can obviously still perform well. That's all for the daily market review to get you prepped for this week. Thanks very much for tuning in with Click Capital, and I'll keep you updated all throughout the rest of this important week. See you again tomorrow. Cheers.